welcome to your regular market and investing program, the DLM Market Hub. Today we'll be looking at distribution and sales process in the bond market. And with me to discuss this interesting topic is Iyobosa Ewosomon, Vice President Fixed Income, Dunn, Loren, Merrifield. It's great to have you, Iyobosa.
Thanks for having me on the show.
Now, focus for today, I first want to ask, when you bring the bonds to the market, who do you sell to and how's the whole process?
Okay, to start from the very beginning, we have an origination team that, they work overnight or what have you to put this structure together, right? And when they're done at their end, it's a process flow. So it moves from origination to sales and trading after the bond has been approved by SEC and all of that. So firstly, what the sales team would do is to organize a roadshow. And by roadshow, I mean meeting with investors, telling them what the bond is about, where we think the rates would be. I'm sure you'd have probably attended some of these roadshows, like the Lagos State Bond roadshow that was, I think it was at Civic Center, where you have a crop of investors coming to the event. And the whole essence of the roadshow is for investors to interact with the issuer of the bond. So you get to ask questions because the issuer, the sales team or the investment house, the lead arranger is just like an intermediary, bringing the issuer and the investor together in
a platform. That's a platform.
Yes, on a platform, on an engaging platform where they can discuss, and you get to ask questions. The economic team does a presentation in terms of what they want to use the funds for, where they think or what rate they are looking at borrowing. It's just to bounce off ideas and to actually sell your product to the market. And after the roadshows, we have a process we call the book building process. The book building process is just basically interested investors. That's after the roadshow has been done. Part of the roadshow could also be, before I go to book building, part of the roadshow can also be taking the investors to see the factory, so you can have like sightseeing and all of that. For example, when we did the Dana bond, we've worked on the Dana, Tar and Chelarams. So we had to take investors to view sites and all of that, because investors would want to know where they are putting their money. And if you say you're going to use the money for this, we want to know that there's an operational platform for the issuer. It's not just collecting money for, lounging and all of that. So we went to, there's sites at Isolo, Masa, Ota, just to, verify and say, okay, this is what we're putting our money into. So after doing all of that, the roadshow, the sightseeing, and asking whatever questions you have, and we provide answers to those questions to the best of our abilities. And for the ones we can't answer, we refer back to the issuer, who most often than not would provide an answer for those questions. After that, that's when you go through to the book building process. So the book building process mostly takes about it opens like a week. So you have houses, interested parties sending in their bid forms, saying this is where I think this bond should be, or this is where I am comfortable buying this bond. And this is after they've done their in-house analysis, they've gotten their approvals in-house. So they send in their forms. It's just like the auction process, the DMO auction process. But this goes over a period of time. So we can say the building process is from 15th to 17th. It closes on the 17th. So the window is open till 17th for you to send in your orders and all of that. After which the price is determined, which is the yield at which the bond will probably be sold. So it's actually determined during the book building process. You're aware of how hard the stock exchange has been working tirelessly to push the retail platform out, to get the retail awareness. However, we're not 100% there yet. So you find out that most of the investors are still institutional players. You have banks, you have PFAs, you have insurance companies, you have closed pension funds like oil companies and all of that. So you have foreign investors as well participating in the bond market.
So on what you said, the process is very thorough, and it's just like a company that wants to take over in terms of privatization, they have to do thorough due diligence, which shows that indeed it is a very viable market and nobody just goes in like that.
It's like I said, it's for what we have today is majorly for institutional players, although we're getting some retail clients to come on board, and it's gradually opening to the retail end of the market. It's an extremely transparent process. There's no hidden the yield at which you go in. If you go in at a particular yield and that yield clears the market, you're very sure of getting what you went in for, except you won at probably the stop rate or the cutoff rate, which might now lead to them prorating it. That's if there's an oversubscription. This is in terms of sub-sovereign and corporate bonds now.
And let's look at the value level in terms of like state bonds, look at corporates. What is the value level, for example, like Lagos State? I know that those are major state that is involved in the bond market. How do you assess the bond value?
Well, in the market today, typically a sub-sovereign bond would trade at minimum of 100 to 200 basis points above the federal government bonds, right? So if you have the federal government bonds say trading at 13 or 12.5, and your state is coming to the market, the least, I mean, from an investor's standpoint, the least an investor would expect is that that particular bond, say for example, a Lagos State that was just issued at 13.5, so and market was trading around about 12.5 at that particular point in time. So I'm saying that the minimum an investor would expect is that you would give a premium of 100 basis points above where market is trading. Now, this does not necessarily apply to all the state bonds, you know, because you have the likes of, I think, Nasarawa, Ekiti, closing at about 15.5 thereabout. Nasarawa is yet to be closed anyways. So it depends. It depends on how the perception of the investor as regards your instrument. I mean, so different states, Lagos, Ekiti. So at the end of the day, it's the investor, the way the rate at which the investor thinks that, okay, I think Lagos State that has a fantastic IGR should trade lower than, in terms of yield now, should trade lower than an Ekiti or a Nasarawa because of the IGR that is generated, I mean, the revenue generated within Lagos, which is like basically the financial hub of the country. So yeah, so you have both on the self-sovereign side between 100 basis to 200 basis point above the benchmark bond, which is the federal government bonds, and on the corporate side you might have 300 basis points to 3.5 basis point above where the sovereigns are trading. That's why you find out that when the interest rates are quite high, you hardly find corporates accessing the market, because to them it becomes very expensive to approach the market or take advantage of the market. But however, if you find rates dropping, you find that most of them are coming to access the market, because definitely the funds they are going to raise from the market will be cheaper than whatever loan they are getting from a bank. But in a high rate environment, you're almost running pari passu with what you're getting from the bank, so you might as well just get a loan or something.
Based on what you said, what are the solutions to this situation? What would you say should be done to effectively improve the distribution and sales process for the bond market?
For the corporate end, I think it has to do with the interest rate environment, and it also has to do with awareness. And outside of awareness, you also want to look at capacity. And I'll take these three. one after the other. In terms of interest rate, the interest rate environment, corporates will thrive in a low interest rate environment because then they can easily access the market and raise cheaper and get cheaper funds as against whatever loan is currently running on their books. That's on one hand. On the other side, in terms of capacity, we also need to build capacity. I mean, investors would need to build capacity, intellectual capacity, to understand what it is, to look at the rating of a bond, the books of the issuer, to understand what the structure is about. So if you're bringing exactly, and the dynamics, because if you're bringing like an asset-backed security to the market, the investor has to understand what he's buying. Because what we've seen today is a lot of our investors are extremely skeptical about putting their monies in things they don't really understand, especially after the experience of equities and all of that. So they tread with so much caution, and you can't fault them on that end, because if you look at PFAs, they're trading with funds that are not theirs, that belongs to you and I, and exactly, so they have to be extremely strict. But in being strict, we need to, because the market needs to grow, the market needs to move forward, and part of the market doing this is also embracing corporates, embracing securitization, and embracing things like that. So the market needs to understand these things. The market needs to understand how to price an amortized bond, or how to trade in amortized securities and all of that. So my point being that we also need to build intellectual capacity outside of just saying, once the rates are low, people will understand and they'll start buying and all of that. I'm saying that we need to take it beyond that. People shouldn't invest in ignorance. So we need to build that capacity. So when you're engaging your financial advisor, you're engaging your issuer, you're both engaging yourselves on a level, on an equal platform where you both understand what you're talking about.
Right then, so it's been very, very incisive discussing this with you. Thank you very much, Iyobosa Ewosomon.
Thanks for having me.
Thank you.